This is a continuation of our More Investment Appraisal lecture on SEMA F3 Financial Strategy. So we got as far as our tips on interest rates and the inflation rates. That brought us on to our overseas investments. A company may make investments overseas, and we may get this question in the exam. So there's different types of risks relating to overseas investments. First risk is transaction risk. This is the risk of foreign exchange moves between the time that you undertake the transaction and the time you actually transfer the money. Economic risk, well, this is long-term transaction risk, the risk that this keeps happening over the long term. Translation relates to the translation of the value of subsidiaries back into your home currency. Obviously, fluctuations in the value of a currency will impact on the valuation of subsidiaries overseas. That's translation risk. Terminology then, well, first of all, the spot rate is the current foreign exchange rate. The base currency will always be stated as 1 in the question, and the counter currency fluctuates against the base. So how do we forecast future exchange rates? We may have to do this if we're undertaking an NPV calculation over the next 5 years in a foreign exchange or a foreign currency. We may have to translate the foreign exchange rates in those next 5 periods. So how do we forecast those? Well, we can first of all use purchasing power parity theory, or the law of one price. This forecasts over the long term and uses the calculation: the future rate equals the current rate times 1 plus inflation over the counter over 1 plus inflation in the base. So that's future rate equals the current rate times 1 plus inflation in the counter over 1 plus inflation in the base. And we did an example of that. You need to do plenty of examples of these to get into your head how to do them. The interest rate parity theory, this then relates to the short term. Very similar. The future rate equals the current rate times 1 plus the interest rate in the counter over 1 plus the interest rate in the base. Again, doing examples in these gets you to understand how to use them. So how do foreign exchange calculations relate to our net present value? Well, our net present value calculation in a question may be in a foreign currency. If it is, the procedure to go through is firstly, do your NPV calculation as normal in the foreign currency. Then use the interest rate parity or purchasing power parity to forecast the foreign exchange rate for the number of periods that you have in the question. We then need to add a line into the NPV to calculate and convert the foreign currency into our home currency. Now we can do this before or after discounting, so we can either discount first and then translate into our home currency, or we can convert first of all and then discount. It depends which one you want to do yourself. And we did an example of this in class. A few other foreign exchange considerations then. We need to realise that the tax rates may be different in the two currencies. So if they are different in those two countries, the tax is always paid at the higher rate. And we did a little example of that in class. Go over it if you're not sure of it. The payments between combinations then. So if there's payments made between the parent and the subsidiary or vice versa, assume that payments from the parent to the subsidiary are always allowed. But be careful, it may tell you in the question that a payment back to the parent is restricted. So just check the question out to make sure. The remainder of the profit will be paid back to the parent at the end of the investment period. So, other risks of foreign investment. Well, we've got political risks. These may be specific taxes on foreign investors. They may allow patent breaches that they wouldn't allow in home countries. And there may be price fixing, so just be aware of these. Check out the question to make sure none of these are mentioned. So we must consider the culture in the foreign country, the stability of the government and so on in the foreign currency, and also the economic outlook of that foreign country. And that was our lecture on More Investment Appraisal.